Today we are breaking down the $14,000 a month covered call portfolio from JJ from Conversations with JJ on YouTube. JJ, thanks for being here. Let's jump right into it.
Always a
The
pleasure, man.
first the first ETF you got is USCL.
hmm
You make $23,000 a year off this. So why
Yep,
do you
that's
got it?
about right.
Walk us
Yeah.
through it.
So basically, this is a pretty much a vanilla S&P 500 cover call ETF. When it comes to the cover call ETF space, especially more geared towards beginners, when we go down the traditional pathway, when you go from broad-based index-based and then moving onwards, as soon as you become more veteranized, which means that when you get more experience in overall income, not income, but overall investing mindset, the overall investing journey and portfolio, you always go broad-based. Something like you always go like in all-in-one equity, something like XEQT, or from BlackRock, VEQT from Vanguard, FEQT from Fidelity, and then there's also HEQT from Horizons, which is known as Global X Canada, or something similar with regards to target date funds that are more common down in the US. In Canada, we don't really have target date funds, which kind of like target date funds is more or less where there's a lot of different allocations within a portfolio. You have a certain number of equities, which are based on common shares of companies all around the world. And then you also have a certain allocation in fixed income, in money markets. So all of that is more or less balanced by the fund provider. And then you just pick a certain date, and then you go with that, and then it's automatically rebalanced in that way. And so when it comes to Canada specifically, although we don't necessarily have target date funds, we do have all-in-one equities, all-in-one growth, all-in-one balance. So stuff like that more or less tweaks between the income and growth allocation and percentage per se between that. And so when it comes to beginners and just starting out in the investing space, whether you want to focus on total returns, whether you want to focus on more on growth, specifically growth in the share price. When we talk about growth, it's not necessarily a set mindset, but when we refer to growth, it's more or less growth in the share price, because at that point, it's more or less easier to track the stock price. Because when we refer to total returns, there's always a calculation between distributions that you receive within a given time period, and then the actual growth in the stock price itself, which gives you that total return basket. Following so
Yep.
far? Yeah.
Yep.
So when we have growth per se, the default kind of definition is growth in the stock price. So you have that kind of investing, and then you also have dividend growth, which is you pick blue chip dividend paying companies that pays you more or less either on an annual basis, once a year, on a quarterly basis, 4 times a year, so once every 3 months, and then you also have a semi-annual basis, twice a year, so once every 6 months or so, based on their performance and their cash flow situation. So you get distributions and dividends for being a sort of like a small time investor in the overall company's profits. So then you have that, and then obviously, which is I guess the main topic that we will be focused on here, is the income or derivatives based cover call ETFs, where you do get some share price appreciation in the underlying based on what you want to invest in, but then you also get a portion that the part of the portion of performance is based on the distributions, the options, the capital options, the sort of income that you get from a monthly basis that's also returned to you either through a NAV perspective or based on just dividends. So the distributions that you collect is a mixture between selling a portion of the NAV from the ETF as well as the dividends that are collected within the underlying. And so based on this first position, we kind of want to more so gear it towards like beginner friendly, more or less simple. So this USCL position, which is the Global X Enhanced S&P 500 Cover Call ETF, it's more or less they use a hybrid between a systematic call position and a hybrid, like they choose different stock prices. So it's kind of like an in blend between, and it's written on the S&P 500. So call options on the S&P 500 SRs. It's call options on the S&P 500 index, and it is given to you on a monthly basis. So part of return is based on the growth appreciation of the underlying SPY ETF, but also part of the total returns is based on the a little amount of call options that of income that we receive from a monthly basis. And so from a vanilla beginner friendly perspective, if you want to go down, if you more or less want to go start playing into these cover call ETFs, be more focused on learning about options, learning about derivatives, learning about calls, puts, all sorts of these kind of perspectives. So I would say this first position, USCL, which is a leveraged version of the USCC underlying holding. So 25% leverage on the S&P 500 cover call ETF. And so this leverage component essentially offsets the NAV lag that traditional cover call ETFs will experience. Because think about it this way: when you have a call position, part of that premium that you are getting is basically you're trading off some of the upside that you could be receiving. It's not guaranteed, but you can kind of think of it as over a long-term perspective. Assuming you have a if you have a long time horizon and you want to grow your asset pool, from a long-term historical perspective of the S&P 500 index, it's more or less given you not factoring inflation, not factoring in your marginal tax rate when you sell eventually. It's more or less giving you between that 9 to 12% averaged out. And so from a long-term perspective, it's going up. And so when you have these capped options in play, part of that upside that you do receive, it does get capped out, because when we look at the charts, it's not always going up, right? You always have these periods of volatility where it's up 20% one year, down 18% one year, and then, so on and so forth. And so when you take these averaged outs, with these kind of cover call ETFs of how they're structured, they capture all of the downside with the underlying holding, but they also sacrifice some of the upside when that underlying rebounds. And so that's why you get part of that as a distribution. And so from long-term perspective, if you want to at least keep pace with the underlying S&P 500 index, you kind of need to have some kind of derivative vehicle, either through leverage, either through zero DTEs, which we'll talk about on another ETF. And so that's why, from a beginner perspective, if you want to start going down the cover call ETF route, one of these USCL, and then I guess the US equivalent there's no leverage. There's no traditional leverage in the US. So I guess the US equivalent, I think the best US equivalent in terms of total returns would be TSPY from Tap Alpha.
Yeah,
So
they added
kind of long
another
spiel,
product.
but
Yeah.
I think it's a good way to start this first ETF.
Yeah, and Tap Alpha added a leveraged version of
They
T-SPY.
did, yeah.
Yeah.
It's part of the
All
Lift
right.
ETF series,
So basically, USCL, boring S&P 500 position.
more or less, yeah.
If you're going to buy VFV or VOOG, if you're a traditional index investor and you kind of come over to covered calls, you do something like USCL as a core position that's boring, S&P 500, writing calls on it.
Yeah.
I like stuff like that. That's just straightforward.
It's supposed to be vanilla, right? It's easy to understand. It's not so complicated, where the more complex, the thing is, the more complex an ETF gets, the more management they have to maintain. And so the more expensive it gets. And when factoring fees, the lower the returns. So that's why when it comes to like a boring index, tracking the underlying index, you kind of need to follow that simplicity route, whether it be growth-based investing, whether it be income-based investing. You still also, your core position, your core holdings should always be these underlying indices, because that also means that there's going to be less of a NAV erosion factor that comes into play with these ultra yielders. And so it's more or less keeping a financial and emotional mindset and emotional check as soon as any sort of market correction come into play, and you don't panic sell, especially when those NAV prices fall tremendously.
Let's move on to your second one. You said it was a YieldMax. We're talking off camera. It's a YieldMax position you have. You make $24,000 a year off it. Which one is it?
It's the YieldMax Magnificent 7 fund of funds. I'm
Talk
YMNG. Yeah.
talk to me about that one. Why do you have it? Is it US listed? It must be,
It's
right? Because
US
it's US.
listed, yeah.
Yeah. Talk
So
me through that
originally,
one.
so this is basically one of the only YieldMax ETFs that I still have to this date. From the previous podcast that we did roughly about 4 months ago, the strategy was having multiple YieldMax funds. So one of them was MSTY. We all know what MSTY is. The strategy-based one from YieldMax. We have Coney, the one from Coinbase. We have NVIDIA, the one NVDY, the one based on NVIDIA. And then we also have Alti, so the short ultra income one. uh, Everyone who's at least remotely familiar, especially down in the US, we all know what Ulti is with their complete NAV erosion, their sort of rebalancing of the strategy, but then that didn't really mitigate the the total returns that they were receiving, or should I say total losses. And so even with those kind of tweakings in the underlyings of what these sort of ultra yielders hold, from a total return and long term perspective, you're not going to be able to, that NAV erosion or NAV lag is still in place. And so, because of the fact that these are also US listed, you have to factor in foreign currency, you have to factor in the US to Canadian currency as soon as you do this kind of currency conversion. And then in every registered and non registered account, save for the RRSP, you always have to factor in that withholding tax perspective. So it's 15% for Canadians if they sign that Canada US W8 band treaty form, which signifies that you are Canadian. And so, because typically, when you hold US listed funds, like if you're from somewhere overseas and from Eurasia, from Europe, anywhere else in the world, distributions withheld by the RS is 30%. It's not 15%. It's 15% that is 15% is gets taken off because of the existing tax treaty between Canada and US. So traditionally speaking, it's 30%. And so factoring all of these plays, and then there's also one more. So I also had YMAX, which is pretty much the total. It's kind of like the HHIS equivalent, basically from YieldMax. They owned everything, but the problem with those kind of funds is that all the underlyings, because they are so subjective to the price movements and volatility and implied volatility of each specific holding they track, and based on their kind of strategy, remember their name is yield first, yield max, which means that they're going to try to generate the maximum yield, which also means that they're going to suffer the highest NAV erosion, the highest capital appreciation, capital depreciation, whatever you want to call it. They're all more or less in the same line. And you also have, basically, they're also suffering huge lag from upside recovery because they're doing 100% coverage ratio at the money, which means that it's maximum yield, but heavily impacted total returns. So all of those funds I had got rid of. There was like, from long-term perspective, there's also way too much rebalancing, way too much adjustments. They also have, when YieldMax switched to their pretty much weekly distributions for each individual fund, so it got way too annoying because I like to track it. I like to track all my distributions received because I do all my own accounting. So I like to track everything from a week-to-week basis every time a distribution is received. But then I got to the point where it's like, with all of these funds that I had put my money in, you're basically getting anywhere between $1 to $10 every week. And so the amount of time that you have to take into to do those manual recordings, to do those tracks, to do all those sort of readjustments and rebalance to see whether or not they are within your target allocation for each holding, it's way too much babysitting to do. Because as soon as you own any ETF, any cover call ETF, any thematic ETF that is mostly focused on single tickers, you have to do so much babysitting. You have to do so much rebalancing. It's too much work. So that's why all of that got scrapped. They're all gone. No regrets, because from peace of mind perspective, from the time management perspective, and from the fact that the opportunity cost of me sitting in these sort of ETFs, I call them ETFs, I guess, call them garbage ETFs. I don't want to say garbage, but like, not doing well, like these ETFs are not doing well. It's more or less, it's way better to just scrap all of them. And so this is more or less So now going back to the topic at hand, with in terms of YMAG, this specific ETF, I've held it for about 2 years. Total returns wise, it's not doing bad. So I have this. Part of it is in my TFSA, and the vast majority of it is in my margin account. And so, yeah.
What's going on with the YieldMax? Are they? I don't know anything about it. I've never done research into them. I've never held anything from them. I've heard them passively talked about from guys like you. But are they a newer fund? Have they been around for a while? It's just they launched a bunch of stuff, and then fast forward a year, everyone's complaining about all their ETFs. That's all I really know about them. Is it because like what's going on with that company in general? Do you know much about them? Like, are they? I don't know. Are people just across the board upset with them about everything they created in the last 12 months?
The thing is, I don't think it's their fault per se, but I think it's the misunderstanding and the lack of awareness of what needs to be understood by the typical DIY real-time investor. Because on face value, the main options trader, Jay Pastorelli, like he's been in the options trading business for like decades, and so when they first launched the YieldMax series products with Tesla, with OR, with NVIDIA, with every single stock ticker that they own, the problem is that when it comes to when they were marketing their yields, you see these gigantic 60% yield, 60 to
Yeah.
100% yield, and then you have Ulti, which is like past 100%, right?
Yeah,
And then
yeah, yeah, yeah.
they also have a bunch of, well, so these ones are longs, but now they also have short versions. So the complete opposites. And so the thing is, when it comes to traditional retail investors, I don't think they do enough research to they take too much at face value, and they don't do
Yeah.
enough backbone research on what the strategy is, what can happen. They don't do any sort of like mitigation strategies. They don't do any sort of hedging strategies. They don't do sort of any real work that they need to do in place every time before they buy the ETF. They take the ETFs at the face value based on their distribution. They think that, oh, this ETF is basically marketing at a 6% yield. Does that mean that I can take that entire 60% yield from an annual basis and spend it? Does that mean that I can retire
Mm.
like 10 times earlier, like 20 years earlier, had I gone down the traditional 4% drawdown strategy? Because when it comes to the traditional 4% rule, you need to factor in such a huge time horizon for the compounding to take into effect, right? So
Mm.
even factoring a 8 to 10% based on the traditional target date strategy, which is you're more or less 100, like close to 90 to 100% like concentrated in equities, and then that equity portion slowly goes downwards as you move closer to retirement, right? Factoring that traditional 60 to 65 year of retirement, and you're starting around your 20s, theoretically speaking. So that portion between equities that you need to capture all the upside and downsides of the common shares of all the best traded stocks, and then that's mitigated by the fixed income portion that's technically required, because from a traditional perspective, fixed income is supposed to not move in the same manner as equities, right? Because especially when you're close to retirement, you need to rely on that fixed income portion to be like a safe buffer, to not move with the total markets in the same way. Otherwise, what's the point of having fixed income if it's going to move in the same way as equities and you're missing all the action per se? So when it comes to that, and so based on the traditional 4% drawdown rule, you kind of need to, I mean, I guess it depends on your risk, everybody's own risk tolerance, risk capacity, their lifestyle, how much income they actually need from a day-to-day, month-to-month basis. And so when it comes to these kind of traditional retail investors that basically have not done so much research in the fact that what does this 60% yield mean? It does not mean that the fund itself generated 60% in returns. It means that they are selling part of your original capital to give you back that distribution. And keeping in mind that all of these strategies that YieldMax does, they are either ordinary income or bad rock, because you're returning essentially part of your principal that you invested in. And so this 60% is kind of misleading in the sense that traditional investors, as soon as they put the huge chunk of money that they think they can retire early on, they're basically playing catch up, right? Because most people who have that long time horizon, they probably would not do that strategy. They would probably follow the traditional, index-based investing strategy from a long time horizon, given that 20 to 40 years per se. And so maybe they'll allocate 5 to 10% maximum in this sort of like speculative alternative-based investing, for fun, right? Because traditional investing is quite boring. And so from that perspective, it's kind of misleading in the sense that not only are they playing catch up now, but they also lost that portion of the capital as soon as those underlying holdings fall downwards, and the recovery is not in the same manner because these YieldMax strategies that are capped out, and so you actually end up in a worse place had you not invested these in the first place, because most of the time they also sell out when the funds are at a bottom. So it comes out to be a double whammy. So not only did you lose all the time and strategy and time and efforts that you could have went down the traditional investing route, or something diversified like from Neos, from Tap Alpha, from lose my train of thought here, but from Goldman Sachs, their GPIC and GPICs. So something more like it makes sense, something more conservative, that the yield projections are between that 10 to 15%, which is kind of what you need in order to basically have your capital and your principal stay more or less flat, that can keep pace, instead of it going all the way down to compensate for the fact that you got these huge distributions. And so that is something that Max probably, but I guess you can't really fault a fund manager for doing what they did, because guess what? The only reason they did what they did is because most real-time investors flocked. Like it was a huge amount of cash inflow, right? So it's like a self-fulfilling, exactly. It's just supply and demand. So more or less.
Is that your sweet spot, 10 to 15%? I do 10 to 14%.
10 to 15% is more or less, yeah.
Yeah, I don't like going over that. Like, ignore my whole MSTE position, but like as far as
I think isn't MST your value stock, so it doesn't even count.
It
it's its own thing, right?
It's completely its own thing. I don't even look at it like a cover call ETF, but when I typically look for just from I'm newer to cover call ETFs. I've been really just serious about it for last 12 months, but I kind of just landed on don't go outside of 10 to 14%. 15% I guess is fine. What's the HHIS? What's that? How much is that? Do you know?
HHIS right now, based on its current stock price, is sitting in that 24 to 25% range.
That's your next one anyway, so we can talk about that. It's got a 24% yield.
Yeah,
it's doing pretty well though with that yield.
Yeah.
But it's going to crash eventually though, because it's tech heavy, isn't it?
It is.
So eventually there's going to be a large dip. It's going to come at some point. But if you've been a bag holder since inception, it doesn't make a difference. You're still good. Depending on what you bought in at, just don't buy in at like the all-time high in like a year or something. Because it's going to crash eventually. All those stocks will. They'll all add eventually at some point. But because what do they own? They own
19 holdings. So I have their listing shown. So it's more or less equal weighted into 19 different positions. You have Broadcom, you have the Mag 7, you have Palantir, you have Eli Lilly, you have Netflix, Costco, Coinbase, Strategy, Circle, Reddit, Robinhood, and SoFi. And so looking at that basically allocation, more or less 90% is in tech and AI.
Yeah,
and 10%, maybe 10% in Costco. In Broadcom is kind of
it's not a bad one that I have.
Yeah, Broadcom is pretty good, but then there's also Eli Lilly and Netflix.
Yeah. I think Netflix is pretty okay for the next little while. It's just the tech stuff, because when all that stuff goes down, it's all going to go down together. But like I said, I think that's all.
It's going to go down harder than the NASDAQ 100, because NASDAQ 100, it has 100 stocks, but it's also only 50% concentrated in tech. The rest of it is in defensives, it's in consumer staples, it's in, okay, there's no financials, but there's everything else that you can think about. So it's like 50 balance, right? Whereas S&P 500 is more or less 40% in tech and everything else because of their financial. And so when it comes to HHIS, it's not like, it's misleading in the sense that they say it's diversified, but but they're still very concentrated in just tech. And so that's why in a bull run, because of the concentration in the better performers and the higher implied volatility of these underlying holdings, you get the high implied volatility of the distributions. You get the heightened concentration in the best performers that are capitalizing on the AI and tech surge. And so that's why so far, because of the fact that we are still, there's not really a market correction. It's been more or less, it's not at all-time highs, but it's still pretty close to all-time highs per se. That's why the overall performance of HHI so far has been doing better than the overall NASDAQ 100. But as soon as a market correction occurs, and it's going to occur, do you have any predictions on when it's going to happen? But as soon as it occurs, it's going to go right down. It's going to fall right down.
Yeah, but if I'm I don't own HHS. I did own it earlier though. I did own it last year at some point. I thought it was great. Yeah, I thought it was overvalued, so I just sold it at a profit. I still was trading like a value investor. I don't care about distributions. I like buying things when they're cheap and then selling them when they go up. So like I sold it because I bought it for like 11 something.
You bought for YouTube, right? Basically.
yeah, I did. And then I was like, oh, I'm making money off this. Let's sell it, right?
Yeah.
Because that's just how I behave. But I think if you're a long-term investor and you own, because I think HHS is a core position for a lot of people. I think it's fine. I don't
think it should be a core position though. That's the thing.
A lot of people I see, well, I think Adriano has like a large position, but I think if it's like number 3 or 4, if you have those USCLs and all that stuff taking up the majority of your real estate, and then you just have HHIS as your core high yield position, I guess I should have phrased that better. Like you have your conservative positions that are bulk of your portfolio, but if you go into like high yield and you need like a core high yield, I go like, oh, that's like a solid one. But if it does drop, and if say there's a market correction, who cares? If you don't plan on selling, whatever, it'll just recover slower. It'll eventually get back to an all-time. It's all just going to come back. So like, if you don't care about that and you don't mind like a small distribution drop when all that happens, you're good to go. Like who cares? Just buy more during the drop. I don't think it's that kind of stock where you should freak out if it crashes or anything, just because it's moving with a market. You just get more because there's leverage.
Yeah.
And that's it. So like, who cares if you don't plan on selling and you don't mind the distribution drop? If there is one, as long as it's not like your primary position, like you still have USCL and stuff. So like, I still think it's a good one, I guess. But it would be, if I ever went high yield, maybe that would be like one I would look at. But even 24% just feels wild to me. That just seems crazy. But they're getting it because of all the volatility. They're so tech heavy. They can get it right now. That volatility will be sapped out at some point. But then, but they manage that fund. They'll swap it out for something else. So they'll maybe swap, because they can, I don't know what they're
adding 6 more actually, based on their new press release. Yeah. I don't think, because they used to have a 15 limit cap based on what they can hold. They got rid of that. And so there's no limit now. And they just came out this week with 6 new funds. So they have Block, they have Oracle, they have Noble, they have JP Morgan, they have Johnson & Johnson, and then you have, I think, Oracle. But there's 6 of them.
So they're blending they're blending in like stable ones mixed with higher volatility ones.
Exactly.
Yeah. All right, they know what they're doing. They're not idiots, so whatever.
They're not YieldMax, so at least
that's what
they are more conservative in the sense that they actually they're doing part of the rebalancing work for the retail investors, right?
Yeah.
So whereas when it comes to US ultra yielders, well, guess what? All the rebalancing and the accounting, you got to do it yourself.
Yeah.
So
all right, let's move on to number 4. I don't have it in front of me. What do you have for number 4?
So I guess we can blend some of these together. We have QQCL, we have HYLD, and then we have Bank and HDIV. I guess we can all blend all of that together, more or less, right?
Call it the conservative bucket.
The conservative bucket, yeah, exactly.
Let's just, for anyone who's not aware, let's just do like a one sentence.
I know, actually, we can add Utes in there too. That's pretty conservative too.
That's hyper. Yeah, that's very conservative. But like, you just listed off the ones where, if I'm looking at it, if I want to do covered call ETFs, I'm probably just buying those USCL, QQCL, HYLD. bank, HDIP, and Utes. Like
Yeah,
I'd probably just stick with that. And I would,
honestly, yeah.
and then at most I'd do like an HHIS for a little bit of a kick. And even then I'd keep, and I would probably not even, I wouldn't even touch single stock ETFs.
Don't bother.
I
Yeah,
wouldn't do any of that stuff. I would just stick with that. And then
because
that's
they're
it.
not exactly undervalued, so you can't trade it like a value stock.
Yeah.
Unless you're looking at Tesla, which I mean Tesla's Tesla, so it's gonna do its own thing. Maybe you can capture it at a very low, and then you can sell it at some point. But then
That's right. That's right.
all the other single stock ETFs, it's too much babysitting and rebalancing to look at from someone who probably doesn't want to basically be staring or having so much time in the markets. So it makes more sense just to be more, more stable and conservative.
Let's do a quick description then of each one here for
Sure.
anyone brand new. QQCL. So when they get that, what are they buying?
Nasdaq 100. And then
HYLD.
the Nasdaq 100 is more or less the same equivalent of TDAC in the US, Top Alpha, or even QQQI from NEOS. So it's more or less the same
Yeah,
thing.
they're the exact same, but this is just Canadian listed.
Yeah, exactly. With some with modestly leveraged. So
It's the
technically
same as.
speaking, it would be more equivalent to the new Lyft ETF from Top Alpha, the new
Yeah, I don't know what's it called.
TDAX, TDAX.
That's what.
Yeah,
Okay.
with 30% leverage. Yeah.
HYLD. What is that in one sentence?
Hamilton concentrated S&P 500 ETF, which is Canadian hedged. USCL, don't forget that. So USCL is the first one we talked about. USCL is non-hedged, so it tracks the US dollar. So you could think of it as VFV. Whereas HYLD, it's more concentrated. It owns more or less 100 holdings, 90 to 100 holdings of the S&P 500. So in a bull market, guess what? It's actually going to perform slightly better than USCL because it's more concentrated in those top holdings, in those top weighted in the Max 7, right? Makes sense. More concentration performs better in a bull run, but more concentration falls harder in a correction. And so, yeah, that's the only difference. And it's also Canadian listed, Canadian currency hedge for the HYLD position.
When I look at stuff like, I don't know, these are like index funds with call writing on top of them. I don't care about performance. I don't really care about short term. I don't care at all about short term performance because there's such long term.
I would care about from the long term perspective. I would not care if it was in my TFSA or Roth IRA or RSP or 401k per se, but these holdings are in my margin account. And from a day-to-day perspective, then you do want to go more conservative and you want to balance out the allocation and percentages between all of these holdings that are in your account.
Is that for the margin calling aspect of it?
Margin call aspect, margin requirement. Yeah, exactly.
Yeah. So I don't think about that I don't do margin, so that's not something I consider.
You have your own margin basically, right? You leverage your company. You don't need to attack on more traditional bank margin.
I don't more variables. There's more ways everything can break. So I just try, and like that's it at the end. But all right, bank. I think that's the most appropriately named one. If you want to give a one-line sentence of what that is for anyone new.
Yeah, 3 insurance companies, top of the 6 top banks, and then we have Power Corporation, which owns Wealthsimple.
What's the difference between this and 60? It's just banks, right?
60 is just the banks. So it's just the top 6 banks. Equal weighted bank is also equal weighted. So 10 positions, so more or less 10% in each position of its 10 holdings. 60, well, guess what? It's in the name. So 6. So top 6 banks, the same ones, same banks, the same bank positions from bank, but then it's also higher leveraged, 33%, and more in the money. So whereas bank has more upside and free reign to grow from a performance perspective, because the call ratio and call aggressiveness is slightly lower, 60 is gunning more for that yield, face value yield, but may be sacrificing total returns, which is combination. So yeah, which is a combination between the stock price and the distribution. So, but they do. This might be mitigated with the fact that they are using higher leverage, but also higher leverage may come at a cost, right? Because
what is it? How much leverage?
33% versus 25%.
Oh,
yeah.
So
slightly more aggressive calls, more concentrated in the banks only, and slightly higher leverage. That gets you that. which gives you more or less 2 to 3%, give or take, on face value on their first initial distribution that they have not announced yet because that's so new.
I'd probably wait to buy 60. There's a user on
I
our
would do it
channel.
for YouTube only, not as an
Yeah,
actual holding.
yeah. And Bank is just kind of, I don't know how long Bank's been around for, but it's
Oh,
more or less,
it's been out for about 4 years now, give or take, since 2022.
it just, I've seen
Yeah.
a lot of people with large holdings in banks and they're really happy with. So it's got
Oh,
some
it's great.
data. It's got data behind it. I like just stick to what works. Why mess around? HDIV, I talk about this one a lot. You want to give a one-liner on this one for
HDIV
anyone new?
is basically 70% in the TSX 60, 30% in tech. So it has a 30% allocation in tech in some of the biggest companies in the US. And plus, there's a tech exposure. And then so I would say 70% is that TSX 60, which is divided between financials, commodities, gold miners, and etc. And then they also have in about 20%. So HDIV is more focused on overall growth because there's that 20 to 30% in that 70% allocation, and the TSX 60 is more focused on, so there's no calls, so there's no cover calls. It's more focused on long-term performance, so like HFIN, like HUTS. And they also have 15% allocation in their Daymax ETFs, which, based on the underlying structure of the Daymax ETFs, they could be performing quite well because 80% of the underlying holdings, based on what they hold, they're uncapped. So they have free reign,
Yeah.
whether they perform well, whether they underperform, and then 20% mitigation with call options on VOO, which is your
Yeah.
vanilla S&P 500 index.
And the last one here, we have Utes
Yes. Same as
and,
bank, top 10
yeah.
utilities and energy.
Yeah.
Right. So, yeah.
Simple. I like ones like that. All right, let's move on to
It's
what's,
so like stuff like this, that because it's more conservative, because when you want
yeah.
to basically pick different holdings for your sort of overall allocation, you want to balance between more conservative, you also want to balance between more aggressive. And so depending on the time horizon of each account that you're looking at, whether that be margin, which may be more short term or long term, depending on your risk tolerance, whether that be your first home savings account, whether that be your TFSA, whether that be RESP, RDSP, RRSP, everything, every account has different goals, different time horizons. And so you should not be focusing only on one strategy or one holding per se for each account, unless you don't have the time. Then you kind of need to do that. But if you want to be more active, you want to learn more, and you can optimize more along the way. That also comes into tax planning. And so that's why each different account, you might want to dial in or dial back or scale up each specific holding as you go. So that's what I
Ma-
wanted to say on that.
Makes sense. Let's
Yeah.
move on to your next ones. What do you have up next?
Next we have well, I have HHIS.U, which is the same thing. It's just in
Mm-hmm.
USD. We have
Yep.
HYLD.U, which is
Yep.
same thing, basically HYLD. It's just because the proceeds that I had swapped out of from Misty, from Coney, from Nvidia,
Oh,
from
yeah.
Tesla, they were. I mean,
Yeah.
guess what? They were all already in US dollars,
Yeah.
and
Yeah.
when it comes to these positions, because they were actually held in my TFSA and FHSA, so it does not make any sense to convert them back to Canadian because you still eat those conversion fees, right? As soon as you
Yeah.
eat that 1.5%, and I don't want to eat that 1.5% or 2%. So
It's a
2% is charged
lot.
by
It adds
Questrade,
up. It
and
adds up.
1.5% by What's Simple. So exactly. So just
Uh,
keep it in, because it's still traded on TSX, which means that there's no withholding tax because it's still traded in the Canadian market. It's just in US dollar currency. So yeah, it makes sense. Just take those holdings, take those proceedings, and then just gets the USD versions. So more or less
you
simplified.
you you sucked out the yield from your portfolio, sucking out the volatility and the
At one point, I was at 35% yield on cost.
what do you
Yeah,
have right now?
it's sitting at 16%.
Yeah, that's normal. That's
Yeah,
good. That's better. That's better.
yeah.
I think overall, like, it maybe not as exciting, but it's like I don't like it when I can't have some semblance of being able to model out my portfolio
Exactly,
performance.
yeah.
It is so crazy, like especially when you probably had Alti and all that stuff in there. It's like, what
I
is
did, yeah.
going on? Yeah, that's wild. Okay, let's move on to the next one.
Next one, we have ENCL, which is just oil. I guess we can lump ENCL and GDV together as its next
GDV is
semi.
GDV is what, gold, I'm guessing, or something?
No, GDV is Brompton's global dividend focused split share Class A
Okay,
ETF.
let's talk about that one.
Yeah.
So ENCL oil, well, actually, I guess start ENCL, then we'll go to GDV.
Yeah. Energy oil. So ENCL is only in my margin account. I didn't really want it in any other accounts because when it comes to energy and oil, it has its own cycles. And so
Yeah.
I'm actually thinking about the fact that I don't really need this position per se because energy and oil, like its allocation, is already in HDIV. And HDIV already does the rebalancing for you. And so
Mhm.
that's why I don't really need this account, this position per se. I've just held it in my margin account because, kind of that's paying around that 16%, 7%, 17% yield. But then you also get those 4% fluctuations in stock price every cycle. And so looking at it from a long-term perspective, I'm actually I think my margin allocation might be too high. Just for my rebalancing perspective, because right now in my margin account, I have USCL, QQCL, HYLD, HDIV, Bank, UTS, YMAG, YMAMG. I have a little bit of allocation in HAS just for that slight booster. And then I have ENCL in there. And so looking at that perspective, I have ENCL and GDB. We'll talk about GDB right after this. But when we look at ENCL per se, it's not that defensive. It's kind of it has its own cycles going on. And so from that perspective, because I'm actively trying to lower my margin cost. No, that's not right. I want to lower my margin allocation towards higher payers because when it comes to because my margin portfolio is pretty big. And so because for my age, my registered accounts, they're more or less a smaller portion of
Oh
my
yeah.
entire
Yeah, you're a
overall
child. You're a
financial
child. You're a
financial
child. We forget.
portfolio.
We
Exactly.
forget you're a child. You're like, I'm like double your age. Yeah, I always forget about that. You haven't had enough time to even grow them. You haven't been around long enough.
My FH,
Yeah,
my yeah. So my margin account, based on what I'm borrowing from the broker and also my own contributions, it's more or less 80% of my entire $1 million plus portfolio. And
yeah,
so, looking at that, Utes I'm completely fine with because it's pretty defensive. Bank I'm completely fine with because it's pretty defensive as it is. But ENCL doesn't really belong there, and so I'm trying to actively go lower in terms of the payers and prioritize more on rock because from a tax deferral perspective. And so when it comes to ENCL per se, I don't necessarily it's kind of hard to predict its movements. It's not really defensive. It's its own position, right? Because when it comes to defensive plays, bank and Utes it can pretty much offset any sort of minor market corrections like adjustments. So they kind of perform opposite when the entire market, such as USCL, HDIV, HYLD, goes down. And so from that perspective, GDV actually falls in that bank and Utes thing, in that bank and Utes that defensive play because it's more diversified globally and they're only focused on the top blue chip companies around the world. And so it's a kind of like a global play on dividend stocks, blue chip dividend stocks. So GTV, you can kind of think of it also as a more defensive play. And GTV pays in that 10 to 12, in that 10% range. So it's more or less the same. So I would say GDV is a great complement to HDIV because HDIV focuses on North America. GDV focuses on a little bit in the US, but then everywhere else around the world. So you get that more defensive structure and nature, especially important for a margin account and for possibly your first home savings account depending on because when it comes to your first home savings account, you have that 15-year time horizon based on when you open it, and then you're forced to sell it either at that 15-year time after that end of the 15 years, and then you have to transfer all the proceeds to your RSP, or you take it out early as a down payment and to
yeah.
supplement the home buyer's plan for your first home. And so when your time horizon is shorter, having something like GVDV, which is more defensive, could be a great complement, especially in your margin account because it has a higher ROC percentage and it's a lower payer. And so when I look at that, ENCL, I kind of feel like is a kind of an outlier, and when it comes to the margin account. So I may or may not, I'm still deciding whether or not I want to keep it because ENCL makes up about 10% of my entire margin account. So I may either trim it down slowly every little by bit because I kind of don't want to take a capital gain on this position,
Yeah, that'd be a lot
right?
if it's
Because
10%. Yeah.
yeah, because all the distributions that have been collected, they've all been realized, right? Which is a mixture between the dividends from the underlying companies and the. So I'd say about 5%, because when we're looking at the 16, 70% yield that they're paying, around 5% is eligible dividends, right? So you can't avoid that. But then the other 10 to 12% is on capital gains or ROC. Because there's already that capital gains portion that is positive, I kind of want to structure it in a way that I might want to take that capital loss to offset that capital gain to pay less taxes and just either get rid of that margin allocation completely or spread it out in all the other positions. Yeah. So it's purely from a tax perspective and a risk perspective that I don't want to own ENCL moving forward.
I think that's tricky how to rebalance in your margin account because of those tax issues. Because if you sell,
Mhm.
are you always just buying into other positions normally when you do rebalancing instead of like contributing more to one position, you just start contributing more to another rather than selling them off? Is that what you try to do?
Yeah,
So you don't,
exactly.
yeah. I got that MST position in my non-reg. I'm never gonna sell that thing.
Don't sell it, man.
I'm just gonna like I don't even know what happened to me.
You're gonna eat such a huge tax bill, yeah.
My taxes are such nightmares right now. Like I'm
Probably,
in taxes
right?
right now. It's horrible. I gotta get. Oh god, I don't even want to think about it. But yeah, I'm just gonna sit there forever. People are like, oh, you're holding forever. I'm like, I have to hold. I'm just gonna hold forever, man. Collect
Imagine
a
that tax bill you
bajillion.
have to eat. It's disgusting.
I'm just gonna get $1 billion in rock. That's the plan. Just keep collecting ROC from the. Hopefully it's ROC.
It should
All
be.
right.
Yeah. Because
How would it not?
strategies.
Yeah. How would it not be? Yeah.
Yeah.
I'm assuming like where would it come from other than that? All
That
right.
makes
Let's
sense.
move on.
We kind of just talked about GDP basically. It's a
Yeah.
nice defensive position.
And like it's more worldwide. I like that.
Exactly. Yeah.
That's a note I put down there. Okay. What do you have next?
We have QQQL, which is Nasdaq 100, basically same from Global X. This time it's no calls. It's purely the QQQ index, and you add 25% leverage, which is awesome from a RSP perspective. And for any account from such a long time horizon, it's the Nasdaq 100. Why not just add a little bit of leverage on Nasdaq 100? You're from a long-term perspective, assuming you don't sell, and there's at least a 10 to 15 year horizon that you don't touch it. Because if you touch it less than that, because of the high volatility of Nasdaq, right? It's going to go up 1 year, it's going to go down 1 year, go up, go down, go up, go down. You can't predict what it's going to do, and so if you need that money, if you need that money shorter, then don't go with this position. But I only have the position purely in my RSP, so it's it's doing its thing. So it's
I've been thinking about that a little bit lately. I'm like, why don't I get?
And
like
you can even add a little bit in
funds?
your non-register account because it doesn't really pay any distributions anyways.
Yeah.
It's purely stock price growth.
I've been thinking about that. Like, hey, try to get like a leverage index ETF. Just
why not, right?
But the only reason why I don't do it,
you can actually replace your XUS with USSL. It's the same thing, just with leverage on it, and you don't get any distributions. Well, you get like 1% distribution, but yeah.
The only reason why I don't do it is not for, I guess not even a practical reason. It's just because I'm like, I just want whatever my index fund to be the absolute bare minimum boring thing, where in my mind, it's only a couple steps different than holding cash. I have cash, I have a cash ETF, and then I have VFV. Like they're so close in my mind because they're just like 10% growth for me or whatever the average. Or it just for me, it still feels like it's a step away from cash for me. It's
Right.
like,
Yeah.
I don't know. It's just that thing. So I think adding leverage would add some element of volatility to it. I'm like, that's not even what it's there for. Just there
Hey,
to
you can
sit.
take that. Come on. It's the S&P 500.
I can.
It's yeah.
I just like knowing that I have like these that I just have a crap ton of cash laying around. I just like that. I'm
Okay.
just from my perspective, like how I operate. I like having actual cash. I like having cash type ETFs. I also like having a ton in a boring index because for
Gotcha.
me that's just like, oh yeah, no matter what I do in life, I'm always good. I'm always good. I can buy crazy positions and like I don't
Mm-hmm.
care because I have all this stuff. And I think just adding that leverage component, it's like, why am I doing that with the most boring part of my like stick to leverage with other things. Um, but like you said, long time horizon, who cares? Add the leverage. Like why? If
Yeah.
you're not selling, why do you care?
Just do it.
Yeah. Yeah. But it's just a psychological thing for me. It's not a performance based thing.
Yeah.
It actually make more sense if I just add the leverage. Maybe I'll do that in my public portfolio. You know what? Yeah, I could.
You
'Cause it would
should.
make more.
You should do it for public for sure.
Yeah, because it would make more sense for me to
Because
do it there.
their overall assets under management is pretty low, and so when it comes to these index based uh leverage versions, so you have CANL, CANL, which is the TSX 60 with leverage. You have USSL, which is S&P 500 with leverage, and you have QQL, which is Nasdaq 100 with leverage. Their assets under management is pretty low. I don't know why, but it doesn't make like, especially from a growth perspective, if you have such a long time horizon, and you know the historical performance of these actual solid indices, it makes 100% sense to add a little bit of leverage. It's very modest. It's not a trading vehicle. It's not 200% leverage. It's not 300% leverage. And it's not, because when it comes to those kind of vehicles, they're made specific for trading because those leverage points resets every single day, which means that when there are corrections, it needs to recover 2 times or 3x more in order to get back to where it started, right? Because if their leverage effect resets daily. But when it comes to these very modest leverages, it's traditional in the sense that it's going to go up 125%, it's going to go down 125%. It's going to get more or less, it's staying more or less in line. And so even factoring in those borrowing costs, from a long-term perspective of 10 years or so, if on average the S&P 500 performs 10%, then you're going to get somewhere close to like no so 150% of 10%. So you might get around that 11 to 12%. That extra 12% compounds
Yeah, you're
every
just
year.
hoping you don't sell on a bad year. That's all it
Yeah.
is. You don't sell on a
Yeah, you
bad
have
month.
that, yeah.
That's all it is. But like I
So
said,
put it in like a locked in vehicle or like a retirement vehicle that you don't plan on touching. That's perfect for that.
yeah,
Right?
yeah, that would make sense for RRSP. Alrighty, what's the next one?
We have our Daymax ETFs, C-Day, S-Day, and Q-Day.
Oh, how are you using those? Are you using all of them?
Yes, I am. So Q-Day specifically is, well, it's kind of the equivalent of HHIS. It's more concentrated. It's kind of like a complement of HHIS. When it comes to this vehicles, when it comes to this position specifically, because Q-Day is at, all of the Daymax ETFs are at 50% margin requirement, so they actually don't belong in my margin account. How I'm using it is that I have a small allocation of Q-Day in my FHSA specifically, and I may add it to my RRSP. Still thinking about it, but that's specifically in that account. C-Day and S-Day, they are, some portion of it is still in my regular non-register account, but they are mostly going to go specifically only in my TFSA because my TFSA is collateralized against my margin account. And so looking at that, rather than buying 15% margin requirement funds in my margin account specifically, which requires more allocation and puts you that much closer to a margin call and any market correction, have these more defensive vehicles such as C-Day and S-Day. Well, guess what? C-Day is dividend paying companies focused on Canada. S-Day, dividend focused blue chip companies in the US. These are pretty much defensive plays that can go very well in a TFSA only if you have margin collateralized against TFSA. You don't really need these positions if you don't, because
Yeah.
if in a traditional sense, if you're just trying to grow out your TFSA, then go all growth. So I don't think C-Day and S-Day probably belongs in that perspective, but from a TFSA collateralized against margin perspective, then it makes a lot of sense to own that.
That makes sense.
Yeah.
That makes sense. All right. What after Daymax? What do you have?
After Daymax, we have Canny, Biggie, and
Mhm.
should we lump in MST in there?
I guess. Kenny Bigger a lot less volatile than MSTE.
Yeah.
Let's not lump them in just so we don't confuse people.
Okay.
So Canny and
Oh,
Biggie,
okay.
you
We
have
can
those
add
two.
ECHI in there as well. ECHI, Canny, and Biggie. Yeah. From 9 Point.
What's it called? HEC.
ECHI.
I don't think I've heard of that. ECHI.
9
That's
Point
from.
enhanced high shares ETF.
Do you know
It's the
IFRS?
same. It's basically the same thing as HHIC, but it's from
Oh,
9
okay.
Point. Yeah.
Okay.
Yeah.
Yeah, I don't know too much about 9 Point. I'll be honest.
That's why,
Okay,
like
Canny.
at the beginning when we were talking, like if you have to sell HDIV, then
Mhm.
if you want to avoid any sort of conflict of interest, then if you're not working with 9 Point, look at their 9 Point Canadian ETF.
Mhm.
It's been
Yeah.
doing pretty well. So have a Canadian equivalent because you already have XUS on the US, but just have one for Canada. 9 Point's a pretty good contender for that.
Yeah, it makes sense. So for Canny and Biggie, for anyone who's not familiar, a one sentence description of them. They're pretty straightforward enough.
Canny and Biggie, they're both from Evolve's Ultra Yield lineup. So they pay semi-monthly, which means twice a year, twice a month, 24 times a year. Biggie is, you can think of it as an direct competitor to HHIS. 10 holdings. So both Canny and Biggie have 10 holdings specifically. When it comes to Biggie itself, it's a direct equivalent of HHIS, so it's a concentrated version of the NASDAQ. They take the highest implied volatility holdings and concentrate it down into 10 positions, equal weighted, and that one is Canadian dollar hedged. When it comes to Canny, it's the same thing as more or less as HHIC. It's a mixture of it's basically the top 10 implied volatility holdings in Canada. So I think you have
Yeah.
Royal Bank in there, you have Fortis in there, you have Enbridge in there, you have Pembina Pipelines in there, you have different mixture in financials and railways and energy. So yeah, and both of them are at 33% leverage. Yeah.
And ECHI, you're saying it's a lot like HDIF?
No, HHIC.
HHIC.
Yeah.
Okay.
Yeah.
Oh, okay. Same type of layout where it's got
Same type of layout,
10.
yeah. But this one is up to 25% leverage, so slightly less than Canny. They're less aggressive on the calls, and so
Sounds
far,
better. Sounds
yeah,
better. I like
yeah,
less aggression when it comes to these kind
exactly.
of
I
ones.
think it's not necessarily okay. Clearly, because HDIV has like what close to 100 holdings in there. 9 Point only has 10, but from a performance perspective, so long based on the great performance of commodities. Well, the majority of 9 Point, well, half of it is based on commodities, on uranium, on oil, on I think there's one on gold. So I think there's a gold miner in there, Agnico Eagle. So yeah, they've been doing pretty well. They've been on the tear. So yeah,
Let's talk
I think it's a
about the
good
best.
one.
Let's talk about your best position right now, MSTE. How much do you have of that? I'm interested here. How much you own, and what's your average
750,
share? What's
750
your
shares. I only have
750?
750. Yeah.
What's your share price?
Share price is 1250.
Yeah. Okay.
Yeah. I haven't added recently. I just
Yeah.
been waiting and seeing. But this position is I have a little bit in my FHSA, but then the vast majority is just my non-registered account. Because originally I was gonna do that case study, but then I was like, it's not that fun to do. Like especially from a YouTube perspective. I think something like clickbaity like MST sounds way more fun to do.
Yeah.
So
You'll get
moving
views off it for sure. Yeah.
Exactly. So moving forward, because I have a plan of having different case study positions. So one of them is based on MSTE in my non-registered account. One case study is specifically documenting my TFSA and how I'm using it against like how to safely use it based on the fact that it's collateralized against margin. So I have
Yeah.
that TFSA portfolio update probably from a monthly basis. And then I have a separate trimmed down, like a toned down version of your $1 million series. And whereas you're trying to gun towards $1 million within 3 years, well, I'm building out a separate TFSA and margin account together from scratch. There's about $9,000, $10,000 in the TFSA. And so basically a road to 100K series in 3 years. So that may be more relatable to beginners to start out.
Yeah.
So
Yeah.
pretty much. So this MSTE, I don't know, case study or something, but I have MSTE and HBTE in there, which is the Harvest that Bitcoin Leaders ETF. So I have those two positions pretty much side by side in that
Yeah.
non-registered account. Yeah.
MST is an interesting one. I don't even check the price until Friday is my live stream. That's when I look at the price typically because I don't see the point in it. I just figure just walk away from it for a year, see what happens. I'm at an $8 something average share price for that one too. So I'm very confident, but I'm like the only guy on the internet who's confident that I'm going to make some good money off this one. Only because I got my share price down.
What's
I
your average
think
share price now?
$8, like $8 and something, low
That's pretty
$8.
good. Okay.
Not bad. I started with like 11 something, and then I got down to 8 something. And then it's kind of spread around all over the place. I got it everywhere. It's a little bit here and there in every account. So whatever ones are in tax sheltered accounts, that's what I'll sell off eventually for like a value investment. And then whatever's in my non-rent, I'll just keep forever. That's sort of how I'm going to do that position. What's
That's solid.
what's your next position?
So three left. I have Blocks, TDAC, and WPay.
Blocks. I was here about that one. And WPay. And WPay. I was just talking to you, Jim Vasquez, about that.
Yeah.
For Blocks, what is that one again? That
basically HBTE, but it's on it's from Nicholas Crypto Fund. And it's more or less the same underlyings as HBTE.
Same thing as everything else.
Yeah.
But everybody got affected with that October crash, so it had the same sort of dip.
I mean, was it a crash? It's just a pullback.
I guess. It was a really fast sell off though. It was really fast though. Then you have
these US positions are only in my RSP. Don't really need it in any other account.
And then what about TDAC? I just did a whole podcast with Sai Katara.
You should be an expert on the TDAC now at this point, right?
I know a lot about it, but I'm interviewing you. You're not interviewing me, so I got you answering the questions. So that TDAC, what do you got it? Give us a one-liner.
Hey, I still like collecting distributions, even though it's kind of like a pain now. So like I'm probably more dialing back. But so far, if you like the last like 100, if you like distribution, especially from a US perspective of one that actually keeps pace or actually is doing slightly better than the actual NASDAQ index, I think this is a great contender. I'm even thinking of adding maybe not necessarily the 30% leverage version of TDAX, so TDAX. Just I might want to see, because the thing is, when it comes to when it comes to the Nasdaq 100 and their implied volatility, having that swap structure that is reset daily and trying to basically get that 30% leverage effect, this may not perform well. I don't know. It's hard to say, but I'm thinking about maybe adding the S&P 500 version, so TSYX, because T-SPY is doing so well. So S&P 500 is technically more stable than the NASDAQ. And so having leverage in that swap agreement on the S&P 500 may do better. And so this position, or only obviously going in my RSP, I might do it in the separate margin TFSA Road to 100K series. I might do it there. I'm thinking about it, but TSYX could be an interesting contender to add to that portfolio.
Yeah, that makes sense. And it's like Sai.
I really like Sai. Like he's awesome.
He was genuine. I get it. Like you get to know these guys a little bit. He's like, I like it when I meet like normal people who just happen to be CEOs and stuff.
He's chill.
Yeah, he is chill. WPay. This is Eugen Vasquez's largest position at the moment. He's a U.S. investor. He did the same thing you did. He did a massive trim over the winter because his portfolio just took a hit, and then he basically sucked out
a lot.
He sucked out all the volatility, I think, from his as well. WPay, I forgot what it was again. I think it's like a bucket of stuff, right? Is that what WPay is?
It's a bucket, yeah. It's kind of like let me do but it's
is it Roundhill?
It's Roundhill, yeah.
So I think it's just
a weekly pay series, yeah.
And it's like everything Roundhill owns in one ETF.
Yeah, exactly.
So that's just basically, I guess, what he was looking for, and what this position serves as is just another as conservative as you
Oh,
can
here it
get for
is.
a Roundhill.
I have an entire breakdown. So we have Apple. Okay, so we have the Max 7, and then we have Berkshire Hathaway, we have Alibaba in there, we have AMD in there, we have Costco in there, we have Strategy in there, we have Netflix, we have United Health. There's Qualcomm in there. There's Broadcom in there. There is Uber in there. There's Robinhood in there. There's Palantir and Coinbase. So all more or less equal weighted. So right now there's 20 positions, so they're all at about 5%, give or take, just low,
What's the
shy of
what
5%.
what's the yield on that?
That is a good question. As of this last payment, it's at 39%.
Okay,
Yeah,
yeah, that's a weekly pay, I think, right?
it is. Yeah,
I think
I
everything Roundhill does is
I'm
weekly
not a
pay.
biggest fan of swap agreements, so that's why I only added a teeny tiny bit in my RSP, just a
Yeah,
very mini bit, just to see how it goes. It's done okay. Like honestly speaking, I would probably just in, instead of this, I would probably own TDAX instead of this. Yeah,
yeah,
because I kind of trust Tab Alpha more than Roundhill from a performance perspective, long
yeah,
term. Yeah.
yeah, yeah.
So if I had to own if I had to swap this out, because so far it's done okay. Stock price wise, it's gone down. I mean, big surprise. Like if you're paying such a big yield, you
Yeah.
kind of have to expect a slightly correcting stock price.
Hmm.
But also that also means that when the stock price goes down, the distribution also goes down with it. So from a long term perspective, it may not. You're gonna have yield. You're gonna have yield erosion, which is
Mm.
more or less the same. Which is more or less the term where when you have a decreasing stock price because the distribution and the yield is based on the NAV. So when you have that falling NAV price, you're gonna have a falling yield with it. And right now, because of the fact that there's no correction, I'm just a little bit worried about when it when it comes to all of these US based ETFs. There's no long term track record, and so there's no telling what could happen any sort of correction. And so from that perspective, it's hard to say. So it's kind of a mystery in the sense that mm, if we're looking at it, because when it comes to these top holdings, it's you're kind of looking at the top 20 holdings of the Nasdaq 100. There's not much else to say about that, but I would say this position only makes sense in an RSP because you still have that withholding tax,
Yeah,
and
yeah.
because of the fact that withholding tax eats away the entire, it's based on the entire distribution. That means that impact of the withholding tax is way more severe because it makes up a larger chunk of your total return, right? Because when you have these higher payers and you have a decreasing stock and you have a decreasing stock price, and that distribution amount makes up more of that performance. When that distribution amount makes up more of that performance, that impact on the withholding tax also matters a lot more because it eats away that performance more rather than if you have a lower payer, you get to offset some of that performance lag from that stock price maintenance.
Yeah, it's only on the dividends though. It's not on the rock or anything like that. The withholding tax is only on U.S. dividends.
Yeah, but when the thing is, yes, that is true. But then that rock only comes in year end, and then when it comes to these commission-free brokers such as Wealthsimple and Questrade, they don't give it back to you automatically. You have to go chase it from the IRS.
Oh,
Yeah,
crazy!
you have
That's
to go fight
crazy.
it yourself. You have to go file it yourself, and so it's a way larger headache. I know that Perry said that when it comes to these commission-based brokers, from RBC, from CIBC, from TD, from BMO, well, you're paying for commissions means that their backline, their accounting is way more set in place, and so they'll actually automatically give it back to you based on the previous year's rock adjustment. But when it comes to these commission-free brokers, I don't know about Robinhood. Well, actually, Robinhood is fine because you're in the US, but especially when it comes to the commission-free brokers, they don't do it automatically for you. So you have to keep track of it yourself, and then you have to go file it. I think with the IRS directly. It's its own headache. So
Hmm.
not worth the time in my when it comes to me, of course. So that's just my opinion, but yeah.
All right, let's summarize these positions. We went through USCL, YMEG, HHIS, QQCL,
Yeah.
HYLD, Bank, HDIV, UTS, HHIS.U, HYLD.U, ENCL, GDV, QQL, UCL was a recommendation to me. The Daymax series,
Mm-hmm.
C-Day, Q-Day, S-Day, Canny, Biggie, ECHI, MSTE, Blocks, TDAC, WPay.
Yeah.
That is it. So essentially,
25 holdings. Yeah.
25 holdings. So what is your going into 2026, your investment strategy for this year? Let's do that. Let's talk about that a bit. It's clearly to reduce volatility, cut down on yield,
Yeah.
stabilize the portfolio. But am I right about that?
That sounds about right because because I don't even need to use this income per se. I like to have it as a buffer because moving forward, I would rather have the income as like a safe end, like a back end that I can tap into when I don't need to, but not necessarily I don't need it right now. But just looking from a long term perspective, because I don't plan on staying in Canada long term. I'm planning on diversifying and broadening my perspective overseas. No long term plan as of yet, but it's somewhere sitting in the back of my mind that it's like, eh, I don't think the from a from a business and then like entrepreneurial perspective, I don't think there's a lot of growth here when it comes to becoming like a business owner here. And so I think it may be more fun to go overseas. So I like to have this kind of income bucket sitting in the back of my mind, like sitting like as a safe that I can always tap into long term. But also that also means that I don't necessarily need such a high income allocation that they are paying, which means that I'll probably be trimming. Oh, actually, I forgot one position. Now that we're going into it, we have HEQL. I forgot. I completely forgot about that position. Yeah,
HEQL.
yeah,
That sounds like a all in one or something.
all in one.
What
Yeah,
is it?
It's
Is,
basically 25% leverage on
is that from
HEQG,
is
all in
that
one equity.
Fidelity? Is that Fidelity? I
No,
don't know.
Global X.
Global. Sorry, what is it again?
Global X enhanced all equity asset allocation ETF with 25% leverage. So it's your growth, but it's your growth all in one equity. It's basically XEQT with 25% leverage.
What's the expense ratio on that? Do you know it in front of you by chance?
Uh,
Whenever I look at these just like index funds, I guess it might be different with leverage. I like to get the lowest possible expense ratio because they
that's fair, but
do.
they also have the highest returns because of that leverage.
Yeah, yeah.
I would say probably in that 1.5%, maybe in that 1 to 1.5% range, just because of the borrowing cost.
That's
I'm
interesting.
ballparking this.
That is high though.
I mean, it's factoring
Just,
in like borrowing costs, right? So
so now you
okay,
have
yeah,
that sitting.
okay, here. Gross expense ratio is 1.46%.
Yeah,
Yeah,
so 1.5. So you just have that as your growth now. That's sitting
growth.
there.
Yeah, growth feeder in my FHSA.
I've been telling people to do that. All the covered call people, I've been like, you got to have some growth thing just sitting there and
Yeah,
just capturing all the upside all the time and just doing it and then
yeah,
forgetting you
makes
own it and
sense.
then feeding into it all the time whenever you can. It's just like, that's it. It was, what's the name? Kyle.
Livingston, passive income investor.
Yes. Yeah. So
Yeah,
he was saying, oh, everyone, you should have like a maximum 15% of your portfolio for covered call ETFs. I was like, yeah, sure, that makes sense if you're a growth investor. Yeah, do that. But then I was just thinking, if you're a covered call investor, you gotta
you
have
still need
that
some
same.
growth. Yeah,
I think you should have that exact same allocation, but for just pure growth.
that makes sense.
So
Yeah,
so just have 10 to 15% just sitting there. And even in retirement, don't just start convert it completely over to income. Have a
yeah,
small portion still capturing upside.
you
Because he
have
was
to.
even mentioning
Yeah,
he had a keys case studying his parents because he's like, yeah, my parents wanted to buy a car, so they just sold off a bit of their whatever S&P 500 index and bought a car with it. It's good for lump sum buying too as
right.
well,
Yeah,
right? So like, there's a lot of benefits of it. Don't just fully convert over. And I think Perry even owns one growth stock somewhere. I think
Athabasca
he,
Oil.
yeah. That's the one
It's
he said.
darling oil stock. Yeah,
He owns a lot of it too, doesn't he?
yeah.
So
It's like I think it's like 10%, 5 to 10% of his overall portfolio. We're just saying something.
yeah, it's a lot because he's quite a large portfolio, right?
It's like
Like a
1.6
couple.
million, give or take.
Yeah, that's
Yeah.
not bad. All right. So what can we expect with your channel moving forward? I know you do a lot of live streams now. You're collaborating with a lot of people. You talk a
Yeah.
lot about a lot of margin talk as
Yeah.
well. I think one of your shows called Margin Talk or something.
Margin Talks, yeah.
It is? Okay.
With Paul, yeah. Margin Talks with Paul and Sean, yeah,
I,
from Better Call
yeah.
Paul.
So what are we expecting from your channel moving forward for this year? What kind of stuff?
Case studies. Yeah, starting those case studies to launch. It's a good question. I haven't figured it out yet.
And don't ask me where to find his channel. It's in the description.
Yeah.
Say, look, open up my description. You will see it there. I get so many people who go like, hey, what's the channel? I'm like, I put it in the description. Also, you can find JJ on Blossom as well, right? You're on
Yeah.
Blossom. So, and your handle on Blossom is JJ Pandy?
No,
On
I
Blossom?
changed it. The convos with JJ makes it easy.
There you go.
Consistency.
Easy. Conversation with JJ on Blossom. Check him out in the description below. Check out his YouTube channel. I watch you every week. You're pumping out content nonstop, so I always watch you.
I try to. It's just like I haven't. Granted, I haven't in the past 2 weeks. But I've been so busy with my finance licensing exams. So,
Oh yeah. You're saying
yeah.
you're gonna be a certified person,
Certified
with
financial advisor. That's it.
yeah, with your
And
own
then,
unique disclaimer.
It's gonna be a different disclaimer this time. Be like, hey, instead of me not being not being a licensed advisor, I am a licensed advisor, but this information is too generalized. It does not pertain to you per se. Which means that if you want specified information, you have to book a meeting with me. Or you have to, as soon as I hit 1K members, then gonna start a membership thing, basically what you did. But,
Yeah.
They can do a consultation from a monthly, I don't know, maybe a monthly or quarterly, or, just questions, right?
Yeah.
Because I think my time is worth a lot. So I don't have that much free time to just I don't always have time to answer questions, even on your Discord server, I don't know if you saw it, but now they're posting super lengthy scenarios. I'm just like, are you
On the
allowed to
Discord?
yeah,
Mm.
even that? So it's
Yeah, that's a little
investing
hard.
questions,
Yeah, I guess for a lot of people, it's a couple things. I don't like. It's not even. You can't give people specific advice and tell them to
Exactly,
buy
yeah.
stuff. So that's one legal thing. So I don't try to tell people you should buy this, you should buy this, you should buy this. I really try to stay away from that. Also, it's really, really hard when someone drops an entire portfolio to be like, hey, what do you think? It takes a lot of time, right? Because it's
Yeah,
a lot of time,
exactly.
and just like the person who posted it, we're all just running around trying our best, not have the day overtake us. I know at least I feel that way. It's just
Yeah.
moving on from one. So we try our best, but sometimes you will just get a general oh, looks good. Really, what I try to do when I see something like that now is I just look for, is anything look broken? Is there a red flag there? Someone just has something that just looks dangerous. Oh, wait, so you should probably rethink this position. I look more for that. But if it's just a switching around allocation slightly, but they're more or less 80% there, the 80-20% rule, I go if they're more or less good, it's yeah, everything looks pretty good. Nothing's really broken. That's kind of what I look for. I just screen for that if I'm looking quickly. But then really it's just you have to understand, can't give you straight up financial advice. I can't tell you to buy this thing. I can't tell you you'll get these returns. I can't legally, I can't. And
nothing is
in the first
guaranteed,
place.
right? So that's
Yeah, and I just don't know everything about you, your exact scenario, but I can give you a lot of information that you can then make the best educated decision on what you think is best for you.
Or come talk to me.
Or just talk to JJ. He's a licensed financial professional. All right, JJ, I think we'll end it there. It was fantastic talking with you, and we will talk soon. Take care.